Hello, everybody. Welcome to another episode of the Mainstream Mortgages Podcast. I'm Derek Vandell and joined with my hosts, as always, Peter Paley and Colton Boudreau. We are also joined by our very first guest on the Mainstream Mortgages Podcast, Trevor Gordon. So, Trevor, could you, for anyone who doesn't know, introduce yourself and let us know what you do?
Oh, well, number one, thank you, Derek, Peter, and Colton for the invite to come on today. My name is Trevor Gordon, and I'm the Business Development Manager for Home Equity Bank, which is the home of the CHIP reverse mortgage. And I actually cover a vast area of geography. I cover Manitoba, Saskatchewan, Nova Scotia, PEI, New Brunswick, and Newfoundland. So I work directly with mortgage brokers when they have a client that could possibly be a good fit for a reverse mortgage.
That's awesome because I did failed to mention that our topic for today's episode is reverse mortgages. So you are the perfect guest to have on for today's topic. So I guess I'll ask the first question here. What exactly is a reverse mortgage? What does it do?
Well, again, a great question. That is hard to sum up in a short sentence because, with reverse mortgages, one size does not fit all. There's clients, there's a vast majority of clients in different situations, but I've had to sort of sum it up to say, what is the purpose behind it? It's really for it allows retirees to age in place by freeing up their monthly cash flow. And, if you look at, our average client, because they're retired, they're no longer working full time, their income is much lower. So as a result of that, a reverse mortgage can take away a monthly mortgage payment and free up their available cash for basic necessities that they would have each month. This is, property taxes, home insurance, food, basic utilities, and the other things that are becoming more and more expensive every day.
Can I just jump in there because
Yeah.
chip reverse mortgages like sort of had a negative connotation for many years until really you came on the scene and started educating everyone about how what a great tool it is. And aging sucks. Like as I get older, like am I gonna have enough money to retire? I look at my parents who made it okay. I'll probably be okay, but there's a lot of people who didn't. So having this access to your home equity is something that can really be used to either top up someone's income, maybe take out a lump sum to gift to a family member, or a multitude of other uses. So, like, what does your average chip customer look like?
Great question, Peter. And you bring up some really good points there. So number one, to answer your question, typically what we see for an average client, and again, we have a very large demographic base where we see a lot of different scenarios. But what we see most of, or at least what I see in my regions most of, is a widowed female, age roughly about 75, 76 years old, looking to stay in their property by doing a reverse mortgage by freeing up their cash flow. So, the first two questions might be on that. Well, one, well, why is it a female and not a male? Well, women live longer. Again, this is something I did not know until I came to this company. And, and why is it that the widowed female now needs a reverse mortgage? Well, if their partner just passed away, then it's very possible that the household income has just taken a major hit and could be cut into half, but they do not want to leave their res. They want to stay there. And Peter, my whole goal today is yes, I want to teach about the product, but I also want to teach about the demographic to let everybody know what's actually out there and what it's like to be an average Canadian retired living in Canada today. And for some people, it's great. They snowbird. They head down south which is sort of the stereotype of what a retiree looks like. But in a lot of cases, it's not like that for a lot of people.
Okay, I'll jump in here. You mentioned retired clients. So I'm retired, spouse or not. How does it look on my end? How much equity can I get? Is there a certain amount? Is there an LTV I have to follow? Like, how does it work as a client?
Great question, Colton. So, the biggest myth that a lot of people think that it's 55% loan to value for everybody, and that is not the case. So, we determine the loan to value by a number of factors. The main two factors is going to be the client's age along with the property location. So, from the client age aspect, the older you are, the more money we'll give you. And if you think about it, that actually makes perfect sense because the older you are, that's going to be the less time that you are going to be in that property for. So a 55-year-old could be in the property for another 30 years, where an 85-year-old, well, they're going to be maybe five, depending on their health, whatever it is it might be. So from a risk standpoint, we can't lend the 55-year-old near the amount that we could the 80-something person because they're going to be in the home a lot less. Or on the reverse side, the 55-year-old is going to be in the home a lot longer. As far as location, that simply just goes with risk with every lender. We're going to lend more in a Winnipeg than we would maybe in a rural area that's in, Manitoba.
That's a really good, I guess, point to note there, Trevor, and thanks for describing that. But I'd like to kind of dial it back a little bit and go back to basically what you were saying a reverse mortgage is and what it does. You were mentioning that it can really like take away a mortgage payment for somebody. And you mentioned that it's mainly for retirees, but could be for other people. So, I mean, taking away a mortgage payment sounds almost too good to be true for somebody who doesn't know what a reverse mortgage is at all, right? So, how do you describe that to somebody? Like, how do I have a mortgage, but I don't have to pay anything?
And you know what? And I hear this so much, Derek, and it's just like I just can't get my head wrapped around it. I don't understand
Mhm.
how it works. And actually, if anything, I think we take the product and probably make it a little more difficult than what it needs to be. If you look at our mortgage and compare it to a regular bank mortgage, really and truly, the only difference is that with a regular bank mortgage, you're going to make a principal and interest payment to that mortgage each month. So you could start out with 200,000 and then maybe after 10 years you owe 150. Well, our mortgage, it's on the same premises. We lend a certain amount of dollars and we simply say that, okay, well, this same mortgage of 250, well, you don't have to make any payments on it. So after 10 years, instead of it going down on the balance to the 150, which I mentioned earlier on the regular mortgage, well, ours is going to increase over time. All right. But we're also, and we, discussed about loan to value and how much we lend somebody. We have over 40 years of data that we use as well when we determine a loan to value, because we want to make sure that when a client does sell their home, that there is plenty of money left over for them to be able to live on. And that's one of the part of our calculation.
So I'm just going to jump in here because first of all, I want to know how you came to work at Chip and what you've seen at Chip. But I want to just maybe interject with an anecdote for a Chip mortgage that I did a few years ago for a client. She lived in her house. She was widowed. Her daughter, her only daughter, was single. The house needed lots of repairs. They are afraid that if they sold the house, that they wouldn't be able to get a good price. And also, the our client or the daughter didn't have enough money to invest in all the renovations. So we put in a chip reverse mortgage. They're able to take their time, do the repairs, do the painting, change the carpet, redo the kitchen. They did everything with that. And um, for the small cost of registering the mortgage and I don't know, I think it was about 14 or 15 months of not paying it and have the interest accrue, they were able to get almost $125,000 over what they would have did if they would have just sold and let mom move on. So it's like a really great tool that we use to help these people who wouldn't qualify for a traditional mortgage do that and come out even further ahead. So I want to know some of your stories that you've seen that where this is really helpful.
Yeah, and that's a great example, Peter, that you're using right now. I came to Home Equity Bank 9 years ago, and that was, prior to coming here, I had 22 years of banking and financial services. And I soon realized real quickly that I knew nothing about this demographic. The only people that I had to compare aging to was my own parents. And again, my parents were snowbirders. They did the things that retirees are supposed to do. And I had just assumed everybody did that. And then I soon discovered that it's not like that way for a lot of people. And this product can give a retiree the ability to age in place and live a better lifestyle. So, you had mentioned your situation, Peter, was a short term, but it made sense because it made this client an extra $125,000 when they sold their home by doing these renovations, prior. There's all kinds of different situations that I see. Now, the number one would be to pay off debt. And that could be a combination of just mortgage debt or credit card debt or whatever the debt might be. That is something that we can help the client out with. So that would be the number one reason. We also see other reasons where maybe the client doesn't have debt, but they're getting very close to running out of their investments, or they're just finding things tougher and tougher. And I'm going to give you an example of a client that I spoke to a couple days ago. She was 70 years old. She had a pension. She was making a little bit more than the average retiree is making. Her income wasn't great, but again, it wasn't a lot of money. And she was at a point now where she said, I'm not looking to get rid of a mortgage payment, but I am trying to free up a little bit of cash flow. And after we spoke for about a half an hour, it was really determined that, you're not quite chip reverse ready at this point. You're still able to handle things and you're still only 70 years old. But what's going to eventually happen with this client, she has no time. She wants to stay in her house as long as possible until she's healthy to do that. In possibly 3 or 4 years, she's going to be closer to 75 and her income is not going to, it's going to be even that much more stretched out, at this time. She's never going to pay this mortgage off in her lifetime. So maybe in 5 years or even less would be a better time for her to come into a reverse mortgage because she's just not quite there right now. So, there's another situation that is maybe not the, product for you today, but maybe it's a product for you that's going to fit for you in 2, 3, or 4 years down the road because you're going to look at retirement differently then. So there's no rule to say take it. It's not like CPP. Oh, take it at 65, take it at 70. Situations change, and these situations change that you're fine today, but something could happen in your life that tomorrow you need to take a look at a reverse mortgage. And like I said, it could be to pay off debt. It could be to help out a family member. It could be to add just some extra monthly income. Everybody's situation is a little bit differently. And that's why I like having conversations with the client, with yourself as the broker to say, okay, what's the best course of action for this client? And does it make sense for them to proceed with this? And, again, if you're in a situation where, perhaps you're looking to, sell the house in a short period of time, what is your plans going to be for that home? And like you said, Peter, in this case with this client that we had, it made sense for her to fix up the home because they had the equity to do it. And it ended up being a much better situation for them financially at the end when they actually sold the home.
And they're able to like do it on their own schedule. Like there would have been
Exactly.
no
It's on
there
their terms.
and there would have been no other product available that could have ever done this for them.
Yes, exactly. And that's why, like I say, all situations are a little bit different. And we see a very, very big different demographic where I see people with a little bit of debt and I see people with a great amount of debt. At the end of the day, there's one common factor in all these situations. It's just getting more and more expensive to live these days. And, with gas prices where they are right now, that's going to affect a great number of things.
Yes, I'll jump in here. What does the future look like? You kind of mentioned that this product's becoming increasingly more popular. So do you think that'll continue on, or will we hit a plateau?
Yeah, great question, Colton. Everything that we're seeing right now with the data that we had, the future, I guess for us, is bright. People are retiring today, still going into debt. The younger the average household is, the less savings that they have. Pensions are becoming less and less common. And this is a real surprising factor that there's a number of companies today, instead of doing a pension, they do an RSP matching, where they might say that, okay, 5% of your salary will go into an RSP and we'll match that 5%. Okay. Right now in Canada, of the people that work for a company that can enroll in those RSP matching programs, less than 40% do it. And it's simply because they can't afford to do it. Now, my point is more along the lines of you can't afford not to do it. But Canadians in 2023 left $2.2 billion on the table by not enrolling in those programs that their employer offers them. So I think that shows for the future that savings and retirement income are just becoming more and more difficult. And like I mentioned earlier, I don't care whether you're 75 or whether you're 25. Filling up the tank, going to a grocery store these days is just getting more and more expensive every day, and it's tougher to save and have money left over.
I really appreciate you coming on the show, Trevor, and giving us this insight. But I do have one more question for you, if you don't mind.
Sure.
What would you say to the people who are maybe a little bit worried about a reverse mortgage? Maybe they don't fully understand it, or they say things like, "Oh, it's terrible. You're not going to have any equity by the time, you have to pay it out, and you're not going to leave anything to your kids, and the interest rate's too high," and all those things. What would you say?
Yeah. So number one, Derek, there's no product that's out there that's right for everybody. Okay. And I don't care whether it's banking, lending, or what, or, whether you're playing golf. There's no golf ball that every golfer uses. All right. So, so number one, yeah, is it right for everybody? No, it's not. My biggest frustration when I do hear about some of the negativity, it's a lot of the myths are false. For example, one of them is that, they feel that, we take ownership of the house, which is not. Okay. Again, it's no different than any other type of regular mortgage you would take. The title still remains with the clients. And this is why I'm talking more so about the demographic than I am the product itself, because a lot of people that have negativity about the product, well, they're in a situation where they would never need a product like that. And, and I explain this to people and they say that, oh, I just can't get my head wrapped around, I'm 72 myself and I just can't get my head wrapped around of needing a product like this. And I said, well, yes, but, you're making between your and your wife's pension, you're making $12,000 a month right now. This is not the type of client that we typically see that's going to
Yeah.
need a reverse mortgage. They're not making 12,000 a month. They're making maybe, 1,200 a month or 2,200 a month is what we see. So, I sometimes chuckle at some of the things that I hear that people think about what occurs with a reverse mortgage, and it's actually not really the case. But my comment is to make sure you have all the facts. To go out and say that a client, um, oh, you shouldn't get a reverse mortgage. Well, get all the facts. What is your income? What is your current financial situation? What is your current expenditures each month? Okay, let's get all the facts together and see if this actually would be a good product for you. And Derek, some of the other things that I hear is, well, clients should just sell their home. Well, it's not that simple.
Then what?
Exactly, Peter. That's it. Then what? So you sell, then what? Well, what if you have a couple of pets? You know, um, what are you going to do to unload all the items that you have? Because if you are at a home and you're being told to sell because finances are tough, well, your next move is going to be into an apartment. And for a lot of people, they do not want to do that. Now, there's some that are, yes, I want to get rid of the burdens of having a home. I don't want to deal with the maintenance. I don't want to deal with the problems. As soon as I'm an empty nester, I want to sell and move into an apartment. Yeah, for some people, they want to do that. But 93% of Canadians want to age in place. They do not want to sell.
It also doesn't really solve the cash flow problem. I mean, you're going to have a
And it
rental
doesn't.
payment and rent is going up, right? So
Exactly. There's going to be costs regardless of what you do, but being able to go to sleep at night in a house or somewhere where you want to be is much easier than going to sleep at night into a place where you don't want to be.
absolutely.
100%. I've just been keeping like a little summary here to summarize, and then I'll throw it to Derek to close
Sure.
out. So the chip reverse mortgage is a total equity play on equity. It doesn't matter about your credit or your income, as long as you have the equity and are minimum 55 years old and can borrow up to 55% of the appraised value of the home, you're going to be in contention for a chip. You can use the money either to take it out as a lump sum or take it out as a monthly stipend to help boost your cash flow if you wanted to. And for application purposes, you only limit how much you can borrow based on age. So the older you are, the more you can borrow, and you prefer uh, urban areas to rural areas. Like you'll cut back if you live a little bit in a rural area. And it's really important to get all the facts for everyone and make sure that we all have a plan so people can age with dignity and age in their home if they choose to do so. Is that fair? Anything you want to
That's
add?
a great summary, Peter, on that. The only thing I would add, you mentioned it earlier about, we do lend we don't have a minimum credit score requirement. We do lend a wide range of credit score, but our average credit score is well in the 700s. It's about 750. So, I want to make that point that it's not a last resort product, and you only do it if your credit's poor. The majority of our clients, like I say, have a 750 plus credit score.
Thank you so much again, Trevor, for joining us today and sharing your insight. And for anybody who's listening, if you believe that the reverse mortgage might be for you, please let us know. Reach out to us at Mainstream Mortgage here. Excuse me, Mainstream Mortgages at 431-482-2187. Our email address is greatrates@mainstreammortgages.com, and we'd love to help you with your specific situation, and we can get you in touch with Trevor if it's appropriate as well. Thank you so much for listening, and have a great day. Bye, Trevor.
Thanks,
Thanks, Derek.
Trevor.
Take care. Thanks, everyone.